When most people think about equity investment, the first thing that comes to mind is buying shares in publicly listed companies. But plenty of large, attractive businesses exist outside of the stock markets. For example, companies that are still owned by the original founder or family-owned businesses. Private equity comes in all shapes and sizes, from injecting capital into fast-growing businesses to help them expand their operations, to buying troubled companies out of bankruptcy and trying to turn them around. Perhaps the best known type of deal is the leveraged buyout transaction, where a group of investors take over a company using a combination of debt and equity. The aim is to improve the company's profitability and to grow the value of the original investment. Private equity investments are different to listed stocks. They're typically not as sensitive to the broader market environment. And because they're owned by a small group of committed investors, these companies can go through dramatic transformations, launching new products, tapping into new markets, or even combining with other companies. So focusing on the nitty-gritty and how that can be improved is what sets private equity apart. That focus on detail and the capacity for change has produced a really strong run of returns for private equity. And private equity investments have beaten public equity investments over the last 10, 20 and 25 years. The industry is still dominated by some of the big names that emerged in the 1980s, the likes of David Rubenstein at the Carlyle Group, Steve Schwarzman at Blackstone, and Henry Kravis at KKR. These firms have been generating consistent returns for their investors for decades, and as a result, private equity has grown enormously, from a couple of $100 million committed in 1980 to over $400 billion committed in 2016. So private equity businesses are everywhere: food companies, clothing companies, tech, healthcare, and transport. Private equity is not without its risks. Companies can falter, and when they do, the debt can quickly reduce the returns to investors. So it's important to be prudent in how a deal is structured. The other thing to bear in mind is the long-term nature of the investment. Private equity funds are illiquid and can last for 10 or 12 years or even longer. So investors need to know that they can commit for the long run. Large institutional investors like US pension funds and endowments have traditionally been the biggest buyers of private equity. But more recently, individual investors have realised that the asset class deserves a closer look. In the years since the financial crisis, we saw private equity firms deploying capital at a steady pace and making impressive returns on their investments. Given the growth in equity markets in recent years, the best private equity investors are now being more cautious and spending more time trying to root out companies that have a good chance of performing in any environment. With investors around the world wondering whether the growth in equity markets can continue, and with yields low on bonds and in the bank, now could be a good time to consider going private.